Good morning and welcome to this Monday, March 2nd edition of Trading Places live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I'll tell you, it was a rough week last week. Things are trying to settle down, although futures were all over the place last night. I believe there was probably about 1,000-point swing on the Dow futures. Last time I looked, and trust me, it could be a lot different just 2 or 3 minutes later. But last time I looked, it looked as though the Dow was going to open around 100 points lower. And, you know, we'll see what happens after the bell rings and whether or not, actually, I just took another glance at 63 now. So very quickly, things are changing. One thing I did notice is that the 10-year Treasury yield is down another 4 basis points today to 1.09%, an all-time low. We'll just throw this out there. Anybody who owns a home has got a mortgage. You might want to check into possible refinance. Rates are incredibly low. The mortgage rates have come down considerably recently, so I want to point that out. But let's go in and take a look at what happened last week, because it was a mess. No way to describe it other than it was a mess. And for the most part, it was indiscriminate selling. It was just sell everything. I don't know. Well, when the market gets fearful, we do see that quite a bit. But even areas, the pockets of areas where the market tends to perform okay or better when things are fearful, even those pockets didn't do well last week, and we'll talk a little bit about that. But first, let's jump in here. We got the Dow Jones Industrial Average. You can see it was just a huge move down. Those 5 candles, that's last week's trading. And you can see it across the board. Everything we look at was down. Now, some rebounded a little bit better at the end of the week than others. That might be the first clue as to what some of the things we might want to be looking at when the dust settles, because when the market's most fearful and we first start seeing some buying, it gives us a little bit of evidence as to what the smarter money or the big money is thinking about. So something to at least consider when you decide, or if you decide to get back in at some point if you've gotten out. The Dow Jones down 357 points on Friday, and believe me, if you weren't watching the action during the day, that was good. Down 357. It was down a lot more. You can see actually a hammer printing. We essentially saw that, although we opened a lot lower than what it shows here. In fact, when you look at the NASDAQ, you can see we opened near the low on Friday and then came all the way back up. So that was a lot of buying off of the open. And I don't know if you read an article. I'm trying to think. I've written so many articles. I think it was the one I wrote in Chart Watchers over the weekend. 5 takeaways from last week's action. And one of the things, the first thing I talked about was the fact that most of the selling last week, the majority of the selling came at the opening bell throughout the week. Now, we did have a couple of days. Tuesday was a lot of selling. You can see on Thursday we had a lot of selling. But if you look at the NASDAQ, you can see Monday's gap down. We actually closed above the open. Wednesday, we closed right near the open. Friday, we closed way above the open. So a lot of it was the fear that was driving the market at the open, with not a whole lot more selling. There was still some selling. I don't want to say there wasn't selling. There was a lot of selling. But I compared it because everyone's saying, well, this is the worst sell-off since 2008, the financial crisis. And I went back and looked at that week. And there was a lot of fear in the market back then. If you were invested in the market, you know what I'm talking about. I mean, it was horrible, getting all kinds of bad news, Lehman Brothers going. There was the threat of our entire financial system collapsing. I mean, those were, not that I'm going to downplay what's going on right now, but I remember being extremely fearful, not just in the financials, but you lose your financial system, you have a meltdown. Obviously, there's going to be a lot of repercussions to that. So when I looked at the week, and I think it was October 3rd to the 10th of 2008, the Dow Jones, or maybe it was the S&P 500 I was looking at, I think went down 19% that week. Last week it was 11 change. So on a percentage basis, it wasn't as bad, although it felt pretty bad last week. It wasn't as bad as the week when we really were feeling the big effects of that financial meltdown. But that week back in 2008, 25% of the drop came at the open, so roughly about 4 percentage points of the 19. The other 15% was actually selling throughout the trading day. People were making conscious decisions to sell throughout the day. There was just a bunch of selling going on. Last week, the 11% drop, 60% of it came at the open. So you're talking about 7 of the 11%, 7 of the 11 percentage points came at open. Only 4% went down during the day. And I don't want to, I'm not trying to downplay the seriousness of the health risk. That's not at all what I'm doing. What I am worried about, though, is whether or not there's a lot of manipulation, a lot of fear. Of course, every headline you turn on, I mean, I can't get away from it. I don't know if somebody's getting away from it. Send me an email. Let me know how you're doing it. Because if you're on your computer, that's all you see. I don't even flip on the TV, especially the news channels. But if I did, I know exactly what's on there. You just can't get away from it. So a lot of times you're just going in, you just sell right at the open. And that's what's causing a lot of these big drops. I was encouraged by Friday for a couple of reasons. Number one, you can see that huge buying that came in on the NASDAQ. And look at the volume. I mean, somebody's buying a lot of shares for it to open at 82.50 and close up around closer to 8,600. That was a lot of buying that took place on Friday. The other thing that's encouraging, and I'll talk about this in a minute, is the volatility index, which hit 50 on Friday. And while you think that, hey, it's never going to get any better than this, I mean, this is horrible. When you see the VIX get up to 50, that's painting a very, very bleak picture. And usually that's when markets find bottoms. So we'll talk about some about that in just a minute. Now I am seeing futures. I mean, they're all over the place. I've got a breaking news saying futures now rise 180 points. So you can see this is going to be one for the ages, probably this week on top of what we saw last week. But you can see the Dow down 357 points, down 1%, down a lot for the week. I didn't calculate each of the percentages for the major indices, but it was indiscriminate selling. We saw it across the board. The S&P took another dive on Friday, although, again, we did rebound into the close, so it was much better at the end of the day than the beginning. The NASDAQ actually went positive, gained almost a point, which seemed like that was impossible early in the day, but we did see a lot of buying there. Mid-caps, a little bit of buying. You can see coming back up closer to the highs of the day, but both mid-caps and small caps also took a big hit. Even though they had been underperforming for a while, they still got hit harder than the major indices last week. Technology, big recovery in technology. So technology and communication services on Friday were the two best performing groups. And when I show you the sector summary here in just a minute, I think, it'll speak volumes as to the indiscriminate selling that I was referring to. But these two groups were the best performers on Friday. And then at the bottom, you had utilities, financials, and real estate. And it's really strange to see utilities and real estate down there when you've got yields, the 10-year Treasury yield dropping as much as it did last week, because dividends on utilities and dividends in real estate look much more attractive to income investors when you see yields dropping like last week. So I would have thought that utilities would have had a pretty decent week, especially on a relative basis. And same goes with real estate, but you can see both tumbled last week with the overall market, again, getting back to that indiscriminate selling theory. Financials, of course, they got hit hard. 10-year Treasury yield, if we pulled up, the group's financials, I'm sure it's life insurance, banks, asset managers, investment services. Those are the areas that tend to get hit the hardest when the 10-year Treasury yield is in decline. But financials, I would have expected, with the big drop in the 10-year Treasury yield, I certainly would have expected financials to be among the worst hit last week. All right, the 10-year Treasury yield, let's take a quick look, see where we are. This is a long-term monthly chart. We are currently at 1.09%. We gapped down today. You can see we've broken down to all-time lows. We've seen in other countries their 10-year Treasury yields go negative. I don't know if that's where ours are headed, but we're certainly now not too far from dipping below 1% on the 10-year Treasury yield. I never thought I'd see that in my lifetime, but here we are. Big drop, though. You can just see here, this is a monthly chart. So these last two candles, that's January and February, and this is starting March. We were up near 2% beginning of the year, and now here we are in half of where we were. I don't think that is as much of a play on, well, I shouldn't say that. I think some of it is a play on a slowing economy, because with the coronavirus, we've got a lot of professionals, research teams that are lowering forecasts, GDP forecasts, and so forth. The one thing about this, I would say, is that unlike a financial crisis where it could take a long time to recover, I do think a health scare, health crisis, and again, I'm not an expert in this field, but I'm assuming that it's going to be kind of a one-off type of thing, that's the flu that's coming around. This is the season for it. And once the season is over, I think any drop in economic activity, I think you're going to see very quickly a lot of economic activity being spurred on the other side of this. So I think from an economic standpoint, I'm thinking it's going to be more of a V type recovery. Maybe more than what we saw for the fourth quarter of 2018, when the GDP was up around 2.5%, dropped to 1.1, and then came, right back up again. Maybe we go lower than the 1.1. I don't know. It's hard to forecast. I don't think anybody really can forecast that at this point. I think there's a lot of variables involved. But the 10-year Treasury yield is dropping, and we've got to deal with that. So obviously coronavirus, that's one of the top stories. The 10-year Treasury yield's a big story. And one story for me, and I've harped on this a lot, and I'm going to harp on it again. Where is the Federal Reserve? In 2018, we had the bond market screaming to the Fed to lower rates. The bond market saw the slowdown coming. The GDP for the fourth quarter dropped to 1.1%. It was announced in January of 2019. And the bond market was, the yields were dropping throughout the fourth quarter. The Fed, looking at all the data, essentially just were acting like they were wearing blinders to what they were seeing in the market, raised rates in the fourth quarter, and then went on and said they were going to raise them 2 more times in 2020. And that is just, looking back, you can say, well, that's hindsight. Well, it wasn't. I wrote about it in December of 2018. And then in April of 2019, the stock market, let me go ahead and give you a chart. Let me pull up the S&P 500. And we'll just go back. Let's look at it on a daily basis. And let's go back, a year and 4 months. That'll be plenty of time. All right, so here was the drop in the fourth quarter. And by the way, the 10-year Treasury yield, if we went back there, you can see the 10-year Treasury yield in the fourth quarter was tumbling here and continued going lower, but that was an inflation story. But here I think the bond market was forecasting to the Fed and anybody else that wanted to listen that, hey, things are slowing down. The Fed should have lowered. If they weren't lowering because of slowing economic growth, they should have been lowering because of lower inflation than target. But anyway, they raised in April. It was right around here. And I'm going to go back over now to that S&P 500. So right here at the end of April was a Fed meeting. And they came out and they said that that inflation, they acknowledged at that point, the inflation was lower than their target level, but it was quote unquote transitory. Well, if you look at an 8-year chart of the CRB index, it's not transitory. We've had lower inflation for 8 years because of a rising dollar. And the way you change all that is lower interest rates weaken the dollar. But anyway, so they refused to lower rates at that point. Look what the market did. Everybody blamed it on the trade war. I think it was the Fed. End of July, here's a Fed meeting. So we're bouncing back. Another Fed meeting. They come out, they finally lower rates, but they say this is it. We're one and done. We don't see any reason to lower any further. This is it for the foreseeable future. Right back down again. And by the way, their foreseeable future was 1 month because their next meeting, they lowered rates again. They haven't produced any confidence. I don't think the financial markets have much confidence in the Fed. And here we are now with the S&P 500 dropping and looking at the 10-year Treasury yield dropping like a rock. And the Fed, all the Fed officials last week were like, well, we're here for the markets, but we're going to check out the data. Do you really need the data at this point? Seriously, do you really need the data? I think the market is begging for a rate cut. Now, there are a lot that argue, okay, what's a rate cut going to do for the coronavirus? Well, first of all, it's just going to buy some time. It's going to help lift the financial markets a little bit, maybe calm some of the fears. That's part of the responsibility of the Fed. Their 2 mandates are to maximize employment and to stabilize prices. Well, as far as I'm concerned, they're not really doing either one by standing pat. But Anyway, I could go on and on about the Fed. I think Jay Powell's done a horrible job. Just my opinion. Agree with me, disagree with me, that's fine. But I don't like where the Fed stands. I don't even know where the Fed stands, but they should be coming out. It should be a coordinated effort with central bankers around the world. And yet we're still sitting here waiting for the Fed to do something. Let's move on. I wanted to show you this indiscriminate selling I was talking about. So here, this is the performance of the sectors last week. It's not like one went down 2% and one went down 20%. You can see across the board, everything was hit hard. You know, if I'm trying to paint, you know, a little bit of a rosier picture on this, or if I'm trying to look at it with the glass half full, I'm seeing communication services, one of the aggressive groups, the best performing sector last week. That seems a little odd. Consumer discretionary and consumer staples, consumer stocks performing near the top. Now, not performing well, mind you. I mean, these are still awful declines, but on a relative basis, would you expect consumer stocks to be doing well, or on a relative basis doing well in this kind of an environment? I would not. I would have thought consumer stocks would have been lower than this. Technology right in the middle. I mean, all of these companies that have been built and have helped carry the market to the upside on strong earnings growth, when earnings are being threatened and everyone says, okay, earnings are going to be horrible for the next year, I would just expect technology, consumer discretionary, communication services, I would expect all these groups at the bottom along with the financials and the industrials. And they're not down there. They're up, you know, again, maybe I'm grasping at straws because I do have a long-term, I'll admit that I'm a long-term secular bull right now. I still think that this is something that is going to create and is creating opportunities to get in. Could it go lower? Of course it can go lower. 1987 crash was in the midst of a secular bull market. If you go back and look at it, it was right in the middle of the secular bull market in the 80s and 90s. But we got crushed for a short period of time. Could this happen? Yes. I mean, it could. If we start taking drastic measures here in the U.S. and the cases start rising and we begin shutting down certain areas like other parts of the world have, yeah, I'm sure that's going to create a tremendous impact on the GDP and increase a lot of fears and so forth. And yes, we can go lower. But again, I think on the end of this, it's going to go a lot higher. So what I wanted to just talk about was, you know, you have to decide. You can't decide when a crisis comes up. You have to decide before a crisis comes up. Are you a trader or are you a long-term investor? If you're a long-term investor, and what I've said over the past week to our members at EarningsBeats is you're in. You know, you're not in while things are good. You know, you're not a long-term investor while things are good, and then things get fearful, and then all of a sudden you become a trader. That is what happens. That's how you actually create those panic bottoms. That's when the last folks say, I can't take it anymore. My money's going to go to zero. I'm just getting out. And then, you know, and if you were in that position, or if you know somebody that was in that position back in 2008, 2009, you know what I'm talking about, you know, and then you don't trust the market. Then the market starts to bounce. You're sitting in cash. If you're long-term, you're long-term. And I think that's really important. From our perspective at EarningsBeats, we try to cater to different groups. We have our portfolios. We have 4 different portfolios. They're rotated every quarter, but they are designed to be bought and held. So if you're a buy and holder, our portfolios are more designed for buy and hold. They got hit last week. I can promise you they got hit. 2 of them slightly outperformed the S&P last week. 2 of them slightly underperformed the S&P. Part of it is, hey, you know, indiscriminate selling, you're going to go down. It's just one of the facts. But on Tuesday of last week, when I wrote the daily market report for traders, I said, hey, if you're a trader, cash is king. When the volatility index starts rising, cash is king. I even pointed out I was moving into cash, more into cash back early last week. And that's what you want to do as a trader. I'm not, you know, some look at the volatility and what we have here and think, okay, this is a great environment for trading. Personally, I think it's a horrible environment for trading because I get into a position and I think I've got a pretty good position. The market starts to rise, and I did try to time it. I think it may have been on, I don't remember if it was on Wednesday or Thursday. I think it maybe on Thursday. No, Thursday was the big selling day. Maybe it was Wednesday. Anyhow, one of the days that we caught a little bit of a break around 10:30 in the morning. We had about a 300 or 400 point rally on the Dow, and I had sent something out immediately. I mean, I normally just send out my daily market report middle of the morning, but I sent something out, a special update saying, hey, you know, the VIX, I think it hit 36 at that point, which was a high that we had seen in prior recent bottoms. And I said, if you want to take a shot, the S&P 500 came down. Let me pull that chart up on the S&P. So the S&P 500 came down and tested that breakout level right here. So it would have been on Thursday. So we came back down, we hit that level, got to 3,007, I think was the low. We came back up just above that level, and that's when I sent out a quick, brief note to members, said, hey, VIX hits 36, we hit price support. This could be an area where we bounce. And if I pull up the intraday, I want to show you what happened. So here was Thursday. So this is about the time I sent out a note to our members. We went down to 3,007, we started to bounce back. And we got all the way back up to 3,100, close to and we were down at 3,007. That was almost a 3% rally in two hours. So it was a nice rally. But I suggested that, hey, if we don't hold that support level, I wouldn't be holding stocks. And look at what happened by the end of the day. We came back down. That was completely gone. And then we had the huge gap down. And 24 hours later, what looked like a great buying opportunity around 3,025, we were down another 175 points. So that's what happens with the volatility. You have to be very, very careful because the market doesn't trade on anything rational. Everything is irrational. I always say market makers go on vacation because they provide liquidity. So when the market starts selling off in a normal market, you've got market makers that are buying. But when you have indiscriminate selling like we saw last week and everything's being sold, market makers are matadors. They're just holding that cape out and just letting it go. They're just letting prices drop. It's the reason why the stock market goes up slowly and comes down quickly. So when you start to see that volatility rise as a short-term trader, I mean, you could short if you want. I don't short secular bull markets, but if this is the kind of thing that you wanted to short, that's completely up to you. I would rather park my cash and my purchasing power is going up when the market drops. And that's the way I look at it. So, you know, did we bottom? Well, you know, that's a hard question to ask. I think short term, when you see a VIX get up to 50, you can see how quickly it came down at the end of the day as the market rallied. When you get a VIX of 50, that normally marks a bottom. And I have a VIX chart I want to show you. So here's a chart of the VIX for the last 5 years. And now these are closing. I just did closes, but you can see the VIX closed on Friday at 40. Here at the end of 2018, the highest close we had was 36. In February of 2018, the highest close we had was 37.5. In August of 2015, the highest close we had was just above 40, similar to Friday. When you look at where we are on the S&P 500 at those levels, right here to low, we went below it, looks like one time, February 2016 briefly. Here, we did go below it in December of 2018, and I believe the only reason we went below it was that the Fed didn't act, and that the Fed acted irrationally. They actually acted the wrong direction. But I think we probably would have held that. Here, definitely, that put in a massive bottom. And even some of these spikes to 20 and 25 put in significant bottoms that you can see. So when you get up to 40 and 50 on the VIX, you're probably throwing the kitchen sink in, at least in the short term. So I would expect that we would rebound this week just because of that, because we were so fearful last week. But who's to say, you know, with the coronavirus, how many new cases come out? I mean, if you start seeing breakouts in more areas in the U.S., New York reported their first case. I think Washington State had the first 2 deaths reported. And if you start seeing different pockets in the U.S. breaking out, I don't know, how the market might react. I just know we're in a very, very volatile, fearful period, and that makes it difficult for the market. As far as economic news coming out today, we've got the PMI manufacturing due out at 9:45. The estimate's 50.8. ISM, February ISM manufacturing index comes out at 10 a.m. Estimates at 50.4. And if you recall, the ISM manufacturing index is the one that dipped below 50 for a few months. So that one will be worth watching. That's 10 o'clock. January's reading was 50.9, and so it is expected to contract a little bit to 50.4, but keep an eye on that. January construction spending, I don't know that will be a huge report, but we are looking for a rise of 0.6%. That'll be out at 10 a.m. as well. Looking ahead, Tuesday, no big economic reports. Wednesday, we've got February ADP employment, and Friday, the February non-farm payrolls. Now, a lot of this is taking place, really without much impact, in my opinion, from the coronavirus. So the February ADP employment report's looking for 170,000 jobs. The non-farm payrolls, the expectation is 175,000. So those will be big numbers. For me, the non-farm payrolls report is kind of like our economy's earnings report. That's a big report. And so we'll be watching that pretty closely on Friday. If that comes in disappointing, that could spook the market, because I think people are already expecting that with the coronavirus, numbers are going to go down anyway. So if we had to have a weak report, it could lead people to think, hey, maybe this is going to turn into a recession. Jobs already slowing, and we know, there's going to be a negative impact to the coronavirus. Anyway, wanted to point out just a couple other quick charts. One positive that I saw from last week, IWF versus IWD, growth ETF versus the value ETF, almost set a new high. Why would growth stocks? I mean, when you look at the components of the Russell 1000 growth, you're talking about Apple, Microsoft, Amazon, Google, Facebook. Those probably make up 25, 30%. I don't know the exact number, but I'm going to guess 25, 30% of that ETF. The value, Russell 1000 value, you've got more companies that are, I don't know, like JP Morgan, Procter & Gamble, Bank of America, AT&T, those kinds of companies. And you would think, again, the high growth prospecting companies like the Apples and Microsofts would get hit harder with the economy projected to slow. And yet we're right up near a 52-week high. I didn't really understand this chart. Consumer discretionary versus consumer staples. I'm still kind of hanging in there okay. We did come down in February. We bounced a little bit at the end of last week. And I still think overall we've got an uptrend in play with the S&P. I don't see any huge deterioration here. So when I mentioned that earlier, I think consumer stocks were kind of a big surprise last week that they held up as well as they did, and that consumer discretionary really didn't pull back much versus consumer staples. All right, earnings. Not a lot of earnings news out this morning. I do want to pull up one company, which is JD.com. They did beat 8 cents versus 7 cents on their bottom line. On a relative basis, this is a stock relative to broadline retailers, not too far from a 52-week high. And broadline retailers starting to strengthen. This was one of the groups actually that did pretty well on a relative basis last week versus the S&P 500. So JD, and if you want to, they've got a new feature now in stock charts. Click on that symbol summary, and you can get the pre-market action. So JD right now trading up 6.75% there. So let's go back. So that's 41.11. So when we look at the chart, 41.11 is going to be right up in here. It's not breaking out on the open. My guess is we'll probably see selling after the open, just because when everybody buys, you got sellers, you got short sellers, which in this case probably in the form of market makers. So JD was probably the only one. Well, we got Dentsply X-ray. Let me pull that one up. Looking at this one on a relative basis. Now, this stock came all the way down, challenged support down at around 49, held it, but on a relative basis down near a 52-week low versus the medical supplies group. So not a big fan there. They did miss by a penny on their earnings, 73 cents versus 74 cents. As far as trading this morning goes, stock down 1.5%. Not too bad considering the miss. Upgrades, downgrades. Apple was upgraded. I'll just go through, show you what they're doing in pre-market. Apple upgraded, stock up 3% pre-market, now up $9. I'm assuming the futures may be going much better. Dow futures, I'm showing up a couple hundred. So it does look like we're going to bounce a little bit here. So Apple upgraded, Baidu upgraded. Let's pull this one up. Baidu up 1% pre-market, actually up 2.5% in pre-market now. JP Morgan was upgraded, and the stock up 0.75%. Downgrades include AAXN, which is a small defense company that's been doing very well. Even with the downgrade, stock up a little bit. NIO also downgraded today, and you can see the stock up 0.75%. Let's move on to the 3 you must see so we can wrap up the show. I just wanted to point out a couple of stocks that, maybe, are bigger companies, not technology driven. Maybe the sell-off could create some opportunities. Bristol-Myers, BMY. Relative to the pharmas, this has been one of the best stocks in the pharma space. Pharma's trying to break out to about a 7-8 month high recently versus the S&P. So Bristol-Myers, one of those fan favorites in the pharma group, and it looks like printing that hollow candle. I would expect some action back to the upside here. JP Morgan, and now we've got a market open. I'll give you those numbers in just a minute, but JP Morgan, another one selling off. I mean, it's been taking a huge hit, but look at it relative to the banks. It's one of the strongest banks. So if I were going to look at bank, this would probably be it. JP Morgan would be the one because it is one of the biggest. It's also been one of the best performers. And then the last stock I have is actually Coca-Cola. Been mentioning recently soft drinks. Look at the relative strength here. It's been building throughout 2020. So you got a stronger group than the S&P 500. And Coke just set a 52-week relative high before last week versus versus soft drinks, and it started bouncing back at the end of last week. So, and you can see today off that hammer starting to show some early strength. So those are the 3 of the 3 you must see. Let me give you a quick update on what's going on with the market. Dow Jones up 264, S&P 26, NASDAQ 90. Small caps up not as much on a relative basis. Same goes for the mid caps. That's it for today. I'll be back tomorrow at Stock Charts TV, 9 a.m. for another episode of Trading Places Live. I'll be back here at EarningsBeats on Wednesday. Happy trading, everybody. Be careful out there.